Hello students. So as promised, I'm creating a video to go over your homework assignments, the homework solutions from Chapter 1, which is about your financial statements. So first up, I'm going to show you how you can access the Excel spreadsheet that I edited and modified after we worked on it in class. So you'll come over here to the chapter resources, and then it'll be found under Chapter 1. You'll have to scroll down here to the bottom for Chapter 1 homework solutions, and then you would just click on this file to bring up the Excel, which I've already downloaded for us. So we started off with S1-2, which asks us to classify the following items as either an asset, liability, or stockholders' equity. I think we got this pretty well during class, so I'll just quickly review this. Accounts receivable is considered an asset. Your long-term debt is a liability. Merchandise inventory is also an asset, as well as prepaid expenses. Accrued expenses payable is a liability. Remember, anything that ends with a payable means somebody owes you money, thus it is a liability. Then you have equipment as an asset. Notes payable again as a liability. Retained earnings, which is found under your stockholders' equity. Land is an asset. Again, another accounts payable, so this is a liability. Common stock is under stockholders' equity, and then finally you have supplies as an asset. I believe this one was pretty straightforward. I don't think we had any issues with it. So we'll go ahead and move forward to the next problem, S1-6, which you can tab over to on this other screen here. So this one, we were supposed to identify the accounting concept, assumption, or principle that best applies to each of the following situations. So I'll read it off your text. Letter A started off with Burger King, the restaurant chain, sold a store location to McDonald's. How can Burger King determine the sale price of the store? By a professional appraisal, by Burger King's original cost, or by the amount actually received from the sale. So this is a two-part question. First, you're trying to figure out what assumption or principle or concept from accounting is being applied to the situation. And then at the end, you're going to list out which price are you actually going to write down in your accounting books. So first, this is dealing with your historical cost principle. And this involves the amount that you're actually going to write down at the end of the day is the amount you physically paid for that asset. So it doesn't matter what the appraisal was, it doesn't matter what the asking price was. If at the end of the day you paid $500,000 for something they thought was worth $600,000, you're going to write down the $500,000. And then the second part of this question, or the answer, is that the sale price is the amount actually received from the sale. So again, that is what you're going to write down. Moving on to letter B. General Motors wants to determine which division of the company, Chevrolet or GMC, is more profitable. I know this kind of stumps you guys up a little bit with you guys were focusing too much on what is it, GMC or is it Chevrolet, when really it was just looking for which assumption this is dealing with. In this case, it is looking at the entity assumption. So that means an entity is defined as anything that's that can stand alone economically. So you have your business, which is an entity separate from your personal entity. And then moving on to C. So this is looking at inflation has been around 5.5% for some time. Woodlake Realtors is considering measuring its land values in inflation adjusted amounts. So again, this isn't really looking at the numbers that they're providing for the inflation rate. This is looking at the stable monetary unit assumption, where in the accounting world we don't really take into consideration the fluctuations of the buying power of the dollar. The dollar is just worth a dollar. Because if you're trying to compare a dollar that's worth $1.20 in 2012 versus a dollar in 2016 that's worth maybe $1.40, you can't get that that comparability that you need for your accounting documents. And then our last one, letter D, you get an especially good buy on a laptop, paying only $300 when it normally costs $800. What is your accounting value for this laptop? Again, this is pulling back to the historical cost principle, just like we covered in letter A of this problem. So the laptop may have been valued at $800, but at the end of the day, you paid $300, and that is the accounting value of that laptop. That is the amount you're going to write down in your books. So that covers S1-6. So let's move on to S1-7. All right. So it says, suppose you manage a Thai restaurant, identify the missing amount for each situation. So this is all about using our wonderful accounting equation where assets equals liabilities plus stockholders equity. So this is just doing a little bit of math, a little bit of algebra. All right, so letter A should be pretty easy because you're just adding the 270,000 plus the 340,000 to equal the 610,000. And the great thing about Excel is you can just put in a lovely formula and it does the work for you. All right, B. So they give us assets and liabilities, but we have to find stockholders' equity. So remember, you are just subtracting your liabilities from your assets to get your stockholders' equity. So again, lovely little equation up top here gives you our number of 25,000. And then finally, we have our assets, we have our stockholders' equity, but we do not have liability. So again, you're just taking your stockholders' equity and subtracting it from your assets to get 70,000. Moving on to S1-9. So this one we did not get to in class, and I am not grading you guys on this one because we weren't able to cover it either in class or by the information I gave you guys on Tuesday. So I figured I would throw this in here anyway because I think it's a great little reference to know which of these accounts are on which financial statements. So you can see some of them are listed out twice, but most generally all accounts are listed out only once on a financial statement. So your assets like your accounts payable, your inventory, they are going to be found on your balance sheet. Whereas your interest revenue, because it is a revenue, will be found on your income statement. Long-term debt, like your other liabilities, will be on your balance sheet. Now, we did not cover statements of cash flow. I'm planning on making a video of that instead of actually taking time in class to cover it. So this is really looking at how the cash is used during the period. So for E, net cash used by financing activities, that again would be found on the cash flow statement. Salary expense, keyword expense, it'll be found on your income statement. Cash, this is technically going to be listed out twice, once on your balance sheet as an asset, and then of course you can't have a statement of cash flows without your cash listed out, so it'll be found on both there. Dividends, this will also be found on statement of cash flows, but it'll also be on your statement of retained earnings. An increase or decrease in cash, this is going to be on your statement of cash flows because it is looking exactly at how your cash has been used during that period. Your net income is going to be listed on 3 places. First, on your income statement, when you figure out what your net income is after you've subtracted all your expenses from your revenues. And then remember, it flows over to the statement of retained earnings. And then you're going to find it on your statement of cash flows. Then you have your net cash provided by operating activities, which will be found in your statement of cash flows. Your retained earnings, again, this is going to be listed on 2 places as well. First, you're going to find what that ending balance is on your statement of retained earnings, and then that flows into the balance sheet under the stockholders equity section. Sales revenue will be income statement, and then your common stock will be on the balance sheet, again, under the stockholders equity section. So I just kind of threw this one in here as a little extra treat for you guys. Right, moving on to E1-19A. So this is kind of a repeat of, I think, S1-7, where we're just doing a little bit of math. Again, they've provided these 3 different companies, and we have to find the missing number. So again, it doesn't have equals and plus right here, but we're going to assume that it does because we are, again, dealing with the accounting equation. So to get your assets, you add your liabilities and your stockholders' equity, so you get 89. To get your liabilities for First Street Bank, you subtract 17 from 26. And then for Pam's Florals, to get stockholders' equity, you subtract 10 from 36. And again, here I'm using handy dandy formulas. So if you were to use like a template like this, you can go in and change these numbers and it'll change that accordingly. Moving on to E1-23A. So this is where we're coming into our first balance sheet that we made. Okay, so they provided all of that wonderful information for us. Let's see here. And I listed it out here on the side as our given information because, again, it's kind of easier to visualize it and comprehend the information here in a little chart compared to the paragraph that they gave as a word problem. So we're just going to walk through it here. So on this half, I listed out our assets. And again, it can be broken down. It'll be broken down into current assets and then your long-term assets. So under your current assets, you always start off with cash. Remember how I said in class today that there is a specific order that your assets are listed out in, and that is in the order of most liquid to least liquid. And in terms of liquidity, that just means how easy is it to convert that asset into cash. So you can't get more liquid than cash, so you're always going to put cash first for 23,000. Your receivables, because that's what people owe you, for 15,000. Your inventory, and then you're going to do a little subtotal here of all 3 of these items. Again, lovely little formulas. And you're going to get 115,000. And then we're going to list out our equipment for 184,000. And then you're just going to add these 2 numbers together to get your total assets of 299,000. Again, remember, I had the little double line underneath to show that this is the final number for this side of the balance sheet. So once we're done with our assets, we move on to our liabilities. So again, we have them all listed out here with our current liabilities first. So that's anything that's going to be paid off in or are due in 1 year or less. So we have our accounts payable, money that you owe. Then we have our long-term liabilities. So this is our long-term notes payable of 165,000. And then you're going to add all of your liabilities together. So the 24,000 with 165,000 to get 189,000. And then we're going to come in here to our stockholders' equity. Now they gave us our common stock of 32,500, but originally they did not give us the retained earnings. We had to figure this one out. So to do that, I came over to this little box that I left blank and wrote in a little formula. So this is where you're taking your total assets of 299,000 and you're subtracting out what's given under liabilities. So we're subtracting 189,000 from it. And you're also going to subtract what they gave us for common stock. So you're going to subtract out 32,500. So you're going to subtract both of these numbers from your 299,000, and that's what gets us, that is what gets us our 77,500 that will then populate this little box right here. So that is how we found our retained earnings. So again, just doing a little bit of math using our accounting equation. And then you're going to add your retained earnings to your common stock to get your total stockholders' equity. And to finally figure out if you balance or not, you add your total liabilities to your total stockholders' equity to get $299,000. And I highlighted these two numbers in yellow so you can see that these numbers have to balance in order for this this financial statement to be correct. Hence why it's called the balance sheet. If something is off, that means you have to go back, play detective, and figure out what you did wrong. And that's why it's so important when you're starting off with your income statement and moving to your retained earnings that you do every step correctly. Double check your math because you don't know where you could possibly have a little error. But that is your balance sheet. And remember, you always forgot this part. You always start off um, with listing out your heading. So you're listing out your company name, which financial statement this is. So in this case, it's the balance sheet. And because the balance sheet's only a snapchat or not a Snapchat, silly me, snapshot, you just list out the day it was created rather than um, the year ended December 31st, 2017. Okay, so this is our wonderful balance sheet. So let's go ahead and move on to our last problem here. So this is looking at preparing the income statement and the statement of retained earnings for the Carson Coffee Roasters Corporation for the month ended August 31st, 2017. So again, always starting off with your heading, and in place balance sheet we have our income statement, and again for the month ended August 31st, 2017. So in your income statement, you always have your revenues and your expenses. So we're listing out our service revenues here, and we're moving on to our expenses, and you do kind of like a little working column here, so that way you can add up all your expenses together to get your total expense, which you kind of push over to your final column. And then to get your net income, again, lovely little formulas, you subtract your total expenses from your service revenues or whatever revenues you've had for that period to get your net income. Now I highlighted the net income because as you can see here, as we scroll down to our statement of retained earnings, this number flows right here into this statement. Again, you're starting off with creating your heading, statement of retained earnings for the month ended. So you have to list out your beginning balance, and in this case it was 0, so that indicates that either they didn't retain anything last period or they are a completely new corporation, just started off, they have nothing in their savings. And so we have to add in our net income or our net loss. In this case, we have a net income, so we just carried that number right there. And then you have to less or subtract your dividends that they gave out for that period. So in this case, 2,300. So that means your ending balance after all of this math, after adding your original balance or your beginning balance with your net income, subtracting out dividends, our ending balance here is 191,600 for your statement of retained earnings. So that is all of our homework problems that we had for chapter 1. I hope this clarifies anything that you might have been having issues with or didn't quite understand. Feel free to rewatch this video as many times as you want. And if you have any questions, please just give me a text. I mean, no, not a text. You guys don't have my number. Never mind. An email. That is what I meant. Send me an email or stop by my office or go see a tutor. So I will see you guys all next week. Have a wonderful weekend.